Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, October the 19th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, I'm here to teach you some different strategies you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Some economic data across the pond. We got unemployment claims out of Great Britain came in line with expectations at 4.9%. Then here in the United States, we got building permits came in at 1.23 million permits pulled, and then housing starts was a bit of a pullback at 1.05 million units started versus the expected 1.18 million units. Now remember, we've been seeing these building permits numbers increase a little bit, and I talk about how those building permits numbers are a little bit wanky because you can pull as many permits as you want. It doesn't necessarily mean that you're going to build, and that's why the expectations came in a little bit lower on the housing starts is what I'm looking at, because the estimates are based on those building permits. So we're not seeing as many housing starts as we are seeing permits pulled. So keep that in mind. That's why I don't really like looking at that number a whole lot. Then we also got crude oil inventories out of the DOE was a drawdown of 5.2 million barrels, was expected to be a build of 2.2 million barrels. Now, you guys know I've been talking about how we're supposed to be seeing a lot of this inventory start to rise due to some of the disruptions that we've seen. It's not happening. It actually looks like a lot of this is the inventories are coming down because they're refining these products rather rapidly. We saw gasoline actually increase to the biggest increase in gasoline inventories in like 8 months. The Cushing drawdown, which is the inventories in Oklahoma, where most of that oil goes through, we also saw a drawdown there, which was the biggest in like 6 months. I also got in a discussion with somebody the other day. We were talking about the difference between the API numbers. If you noticed, if you're trading a lot of oil, that there's an API number and a DOE number. API is the American Petroleum Institute, and they survey a lot of these different oil refineries, and it is more of a volunteer basis. So these guys can just volunteer the information or not volunteer it, and they don't have to give the exact stuff. With the DOE, it is government mandated. They have to by federal law. So that's why DOE is a little bit more of an important number. But with those drawdowns on those crude oil inventories, we're seeing crude oil push quite a bit higher here to $52 handle, and it has created a high here for the past year. So very important to note, looks like crude oil is wanting to cruise, but people are discounting the fact that there's a lot of gasoline out there now. So it's all about the crude oil numbers. Also, there was some information coming out of Saudi Arabia that they might really start looking at crimping the production out there. We're also still seeing the inventories for the offshore rigs, the rig counts going up. So that's also going to kind of keep that at bay, if you will. Anyway, and as crude oil is above $50, it makes it easier for us to frack and start increasing our rig count. So start to look for that to happen. Anyway, crude oil up into the 52 handle 1 year highs, just cruising along. Then we also have gold futures right now up $10 and breaking above that 200-day moving average, which is very important to note that that is a resistance area and it's above that. So it will have yet to see if it stays above there for the day. But as of right now, looking like the bulls are taking control there. On to the bonds. Again, cats and dogs living together today. Everybody's happy because everything's up. We have the bonds up by 11 ticks right now and above this 50 Fibonacci level. We got above there and settled above there yesterday, so it's giving the green light to the bulls. I foresee it really wanting to go back right here. This is where the point of control is, the most time and volume, so that would be where I would see a target for that. On to the Dow Jones Industrial Average, up almost 60 points right now, up against that 50-day moving average. Just, nothing to see here, but we're stuck in a range, and nothing's going to happen until we really start making some moves. And the NASDAQ up by 4 points again today. Really nothing to note other than there's not a whole lot of talk going on. We've got earnings coming out, and earnings are coming in pretty decent as we speak. So, or so far this earnings season, I should say. Then we got the E-mini S&Ps up 7 points on the day. They are, again, up against that same basically 50-day moving average, and that should act as a bit of resistance. But at the end of the day, we could easily just see it pop back and forth here because of being stuck in that range. Coming off of the highs, as you can see with the 15-minute chart here, and the last half an hour or so, we made new highs and have since just taken a bit of a pullback. The market really started rallying off of those DOE crude oil inventories, drawdown numbers. So the overall market maybe just taking a little bit of a breather here, taking some profits on the upside. A couple of things that I've done with General Mills, I put on a poor man's covered, or a poor man's, sorry, not even a poor man's, I put on a synthetic long in there. And with this, I did the, the January 65 calls and the 65 puts. So I bought the 65 calls, sold the 65 puts to create that synthetic long. The benefits of that is that I didn't have to lay out all that money to buy 100 shares of GIS, and it acts exactly the same way. I'm going to lose money on the downside, I'm going to gain money on the upside. Well, as you can see here, I put it on over a month ago, and it's done nothing but take a slide. So now I'm looking at a point where I need to start being mechanical, being a little bit more defensive with it. So I went into the November and sold the 65 calls and collected 24 cents for that. Now, why did I do that? I'm capping my upside, yes, but what I'm trying to do is lower my overall basis on that trade. And I'm going to continue to start to do that with this trade because I don't want to lose all the money that I put into there. I'm going to protect my downside, lower my basis, increase my probability of profit to the upside, and also lower my break even on that trade, because that break even was right around the 65 handle. So now I'm collecting another 24 cents. I can lower that break even a little bit, increase my probability of getting back up to that level. So that's why I'm working with that one. And then on to Lululemon. Lululemon is one of the few stocks that don't have earnings in this next cycle, that has pretty decent implied volatility percent, albeit it is not quite 50%. It is very close to it. It also looks to me like it's found a bit of a bottom here and is starting to make inroads to the higher side. So I decided to go in there and sell some puts, and did the November 52.5 puts and collected 59 cents for that trade. So looking for a little bit of movement up there, try and get 50% of my profit on that one. And then on to GDXJ. The overall market here has high implied volatility, especially for an ETF. It's above 50, and it's high implied volatility up into the upper 50s. So I decided to throw in a bit of a strangle in there, and went into the November, sold the 36.48 strangle, so it's the 36 puts and the 48 calls, and collected $1.10. Now, if you remember, I just took off my strangle in GDXJ from the October where I had to lower it and try and create a tighter strangle, increase my probability of profit. Had I waited till today, I probably could have gotten another 20 cents out of that. But you know, hindsight being 2020, you never know what's going to happen there. So I just decided to throw on another high probability trade around GDXJ. All right, on to Smith & Wesson. This is basically one that I just took off, and I had on the November 24 puts. I originally sold them for 90 cents, bought them back for 40 cents today, got 50% of my max profit. I was trying to get out of that one yesterday, and it just never came to fruition. A little bit more theta decay for me today, and that one worked out nicely. So that's about all I got for you guys today. Friday's webinar is going to be on long strangles. I'm already looking at a couple of things that we can do that with. USO looks like it's a great one that we could put a strangle on. So we're going to be looking at something like that, and I'm going to have to call these guys and get that garbage off of my computer. So, all right, so check that out. Go to protraderstrategies.com, sign up for that webinar. The more the merrier. Hope we can see you all there. If you can't take that, take it easy.